Hello and thank you for joining us today as we discuss how to grow your investments efficiently. My name's Andy Buick. I'm joined by Matt Almond, a financial advisor at True Potential, and Tom Robertshaw, another financial advisor at True Potential. As I say, we are going to be discussing how to invest efficiently, certainly from a tax efficient manner, in the build up to retirement. We will be addressing three different topics here. So the first one is, what are your tax-free allowances? What are the benefits they can offer your investment, and what should you consider? We've also got the different tax benefits of different investment products, how you can use different products to increase your tax efficiency, and how maximising your pension contributions could help you prepare for retirement. We're going to discuss pensions first and foremost. So pension allowances, obviously, there's quite a lot to go into detail there. So we'll start with the easy one, Tom. What is your pension allowance?
Yeah, so your pension allowances, or essentially your annual allowance, is £60,000 up to the low of your relevant earnings. So say, for instance, your relevant earnings or your salary that's coming in is lower than that £60,000, and you'll take that salary amount essentially. With your annual allowance, you've got to be a bit careful. It's a bit of a tricky area, to be honest, because you've got to take into account both personal contributions, employer contributions, from both parties, but you've also got to take into account tax relief as well.
Okay.
So it should be a really simplistic area, annual allowance, but it isn't. It's one that we, all three of us, have to regularly calculate for our clients. And you might be receiving, making contributions from one pension, and you might want to top up another pension. Mm-hmm. If you're in that situation where you're unsure as to how much you can contribute into your pension, always come and speak to us, because we'll be able to work it out. No problem at all.
So what you're saying there essentially is the annual allowance is this overall allowance that you've got for each pension. It's not just specific to, say, one pension or another pension. It's across the board. Yeah,
exactly. So let's just make it really simple. As an example of this, say for instance you're contributing in personal contributions of gross, which is with tax relief, of £20,000, mm-hmm. And you've got a annual salary of £40,000 essentially. Well, you can only contribute up to your £40,000 salary, mm-hmm. and you've already contributed with tax relief already £20,000 into there, so you can contribute another £20,000 with tax relief in that situation. That's just a really simple example of that. Now, because we've got to take into account the tax relief, saves that £20,000, which is the gross amount that we can put in. With tax relief, the net amount that you can put in is £16,000 in that situation. Okay. Now, there's much more complicated, areas of this, mm-hmm. Which we could go into, but it would probably be a bit more confusing, and that's why, it's really essential to come and speak to your financial advisor around the annual allowance, because, like I said, it's something that's more complicated than what it should be, unfortunately. Yeah.
And how long does that last, that annual allowance? Is it something, the name annual, is that tax year to tax year? Is it calendar year?
Yeah, it's exactly that. So obviously it starts in a tax year, which is on the 6th of April, and finishes at the end of a tax year, which is the 5th of April. Mm-hmm. So, if you've you're a high earner and you want to put money away into your investments, it's very, very important to maximise that allowance that you've got. Just given the fact that you get the tax relief, which is a huge benefit. Yep. If you're a higher rate taxpayer, say for instance you're a higher rate taxpayer, you get relief at source, which is what's contributed into your pension. That's 20%, and then you can reclaim another 20% on top of that at self-assessment. So it's a huge benefit to make use of, even with the changes that we've seen in the recent budget. With inheritance tax, which we can come on to at some point as well. But maximising your pension allowances is really important. If you're a basic rate taxpayer, if you're a high rate taxpayer, it's even more important, and additional rate taxpayer as well, exactly the same.
In terms of the pension itself, how does that protect your money? You've mentioned the tax relief, obviously, but how does it protect your money in terms of growth? Is there any tax applied to growth savings or anything like that?
Exactly. So, if you look at the pension, it's completely free of capital gains tax, mm-hmm. which is a huge benefit. So if any growth that you get in there, it's not subject to capital gains tax at all. Now, obviously, when you withdraw the money from your pension, 25% of that money that you got in your personal pension is tax-free. The rest is taxable at your marginal rate. But you've got to remember, with your pension, you're going to be withdrawing it at a point where you're a low rate taxpayer. Mm-hmm. So, for instance, if you're saving in your retirement and you're a higher rate taxpayer, you benefit from that 40% tax relief when you're putting the money in. And then when you retire, even though you're going to be taxed on the way out, 75% of it will be taxed on the way out, it might be taxable at a low rate of tax. So it's a win-win in that sort of situation.
Yeah.
The majority of the time, it is taxed at a lower rate of tax. We very rarely see it to be really where we've got clients who are pushing themselves into high rate tax bands with pension withdrawals.
That's a massive benefit for contributing towards pensions. You hear them all the time. You speak to clients. My friends down the pub will say, well, we can't really go and contribute into something like that. Well, I'm going to be paying tax on exit. The difference is we control that tax point when we take it.
Yeah.
And 9 times out of 10, we're taking it from a much more lower threshold.
Yeah, and as you say, you get your tax relief obviously on the contributions.
Yeah.
So that's a larger sort of compound interest that you're gaining on any contribution at that point.
Exactly.
Lovely, thank you very much. Easy one to start off for you, Matt. What's the allowance for each of those products, the ISA and the junior ISA?
Yeah, so we've got ISA, individual savings account, JISA, junior individual savings account, different set of allowances. ISA's £20,000, junior ISA £9,000. That is across all types of products. So you might have heard stocks and shares, ISAs or JISAs, cash ISAs. That is collective what you can contribute within the tax year from the 6th of April to the 5th of April. So, for example, give you one scenario. If I've got a cash ISA, I could put £10,000 in that cash ISA. I've utilised £10,000 of my tax year ISA allowance. That means I've got 10,000 if I'm in a lucky position to have that money to put in elsewhere. Now, if I had additional capital, for example, I've got £30,000, I've can put £20,000 in the stocks and shares ISA, and then I also have got an opportunity for maybe to invest for my children. I can then look at maybe using some of that £9,000 JISA allowance, using some of that £30,000, the £20,000 for me, the £9,000 for my children, and investing in a tax efficient wrapper of what an ISA is.
Yeah, you mentioned there cash ISAs and stocks and shares ISAs. I think that's one that people assume a cash ISA is just holding money in cash.
Yeah.
Could you just go into a little bit more detail as to the difference between the two?
With the stocks and shares ISA, what it's invested in, it's invested in other assets other than just sitting in cash. A cash ISA, 9 times out of 10, at the moment, we've probably seen quite high rates, probably within our lifetime. People have no doubt probably seen a lot higher at certain rates. But what stocks and shares ISA allows you to do is invest within the market, invest in different asset classes. For example, fixed interest securities, government corporate bonds, equities, shares around the world, and different alternatives, gold, oil, stuff like that. So the underlying value of that asset will fluctuate on a day-by-day basis, and that's based on the value of the asset that it's invested in. Whereas a cash ISA, realistically, it's 9 times out of 10 there'll be a set interest rate if it's a locked-in account or a notice account, or there'll be a rate of return which is expected. So realistically, from a cash ISA to a stocks and shares ISA, you'll see a cash ISA probably will grow relatively slow, but consistently moving in the right direction. Depending on a stocks and shares ISA, depending on how you have that money invested, the journey that investment goes on will fluctuate depending on the strategy. Obviously, in a perfect world, we want it to be nice and smooth and consistent and rising up. But you might see during high levels of volatility within the market that there might be a bit more fluctuation within that compared to a cash ISA.
Lovely, thank you. We touched on tax with the pension, so probably similar question to you on the ISA. How is it taxed sort of internally when you take money out?
Completely tax-free. It's one of the most efficient investment vehicles out there, and it's free of capital gains tax. What's even better, on withdrawal, free of income tax. So it's a fantastic tool to be used alongside a pension, to be alongside everything else, to basically meet your requirements. It's a brilliant opportunity for you if you have capital requirements down the line. If you've got an ISA there, that's one way of raising capital without incurring any income tax or capital gains tax. But whilst the money's invested and on exit, no tax issues at all. But you are capped at the £20,000 and £9,000 per year.
So just to be certain there, or a bit more clear about it, you could put in £20,000 a year using your allowance each year over, let's say, 10 years. At the end of it, you could take all of that out in one go and not pay a penny of tax.
We'd rather you speak to us first and see look at maybe somebody who's for that. But that's definitely what it's there for. And I think, again, maybe Tom might expand on this a little bit. Pensions were capped at minimum pension age. We can't access our investments until you've hit that minimum pension age, which is 57 for pretty much most people from 2028. With an ISA, there's no cap on that. So realistically, you can go and take that money out today or whenever you want. It's not capped by time. Another thing as well with an ISA, if you had an ISA which was valued at £100,000 and you had a capital requirement of, let's say, £50,000, and you were maybe bridging a bit of time. So, for example, this is sometimes used when the people are purchasing property. What can sometimes happen is they'll take that money out of their ISA, Yep, £100,000 minus the 50, they've got £50,000 out. As long as they replace that money back in with the same year, you're putting that money back into a very, very, very tax efficient environment while saving that £20,000 allowance.
I'm literally at the moment, as we speak, doing something like that with a client for the new tax year. So because they're going to purchase property just in the new tax year, we can take some money out of the ISA, and then once the other property is sold, we can put that money back into the ISA as long as it's in the same tax year.
Yeah.
Because of this, obviously the tax year is coming up in April, we'll have a whole year to be able to put that money back in there. And that ISA flexibility rules is a really good thing.
Probably a bit of a tough question, this one, because I think there's answers dependent on what your goals are as a client and what you're ultimately looking to achieve. Which should you use first, a pension or an ISA? I'll start with you, Tom.
Yeah, so there's a few things that this sort of boils down to, really. First thing is term. So if you've got a long time horizon, you can put that money into the pension because it can grow, you can get benefit from that tax relief and benefit from the fact that you're going to get compound interest from that tax relief as well that you put in there. Remember, at the minute, pensionable age is 55, rising to 57 in 2028. So you've got to have a long time horizon to be able to do that. Now, the other thing is as well, when a pension is probably more suitable, is if you're a high rate taxpayer, which you mentioned before. If you're a high rate taxpayer, you're going to benefit from not only 20% tax relief, you're going to benefit from 40% or 45% if you're additional rate taxpayer, which is certainly beneficial to those who are earning that amount, because like we said before, when it comes to the withdrawal side of things, we can help and make sure that you're only getting taxed at the most at basic rate of tax. Yeah. So there's a huge benefit there. Now, to clients who want a bit more flexibility, and they may need the money. There may be quite a younger client that might need the money, in future years for maybe children or university fees or anything like that. Then the ISA is the better option from them there, because if an ISA, they're both fantastic and the two most tax efficient products you can have. But if an ISA, you're free from any capital gains tax and income tax. And again, the ISA is a really good option for those who might need a lump sum requirement in the future. So they're saving for a lump sum requirement. The ISA is the better option really for them there. But again, if you're thinking of just even from a retirement planning point of view, a combination of both.
Yeah.
Because, we've said this plenty of times between us, with the pension, you can put money in there, you can benefit from the tax relief, and then when you come to withdraw from it, we can actually withdraw up to your personal allowance and not pay any tax at all, plus take a little bit of tax-free cash, plus use an ISA alongside that, and essentially get a lot of that income out there completely tax-free. So a combination of the both is usually the best option, but if you've got a bit of a funny scenario like we discussed before there, one or the other might be a good option as well.
Lovely.
I think what you've got to kind of realise is if there's no basic perfect product, there'll be a perfect product for the circumstances that you're in. That might not be the case going forward. It's always the case of whenever you do have capital and you're looking to invest, having a quick chat with a financial advisor, what we can do is ask you the questions and try and circumnavigate the problems that you're all thinking about, where to put the money and where we think is actually the most beneficial for you alongside your goals.
Yeah,
to
again,
that money working.
Banging the same drum, but I think it is really important to speak to a financial advisor to get to the bottom of sort of what the right goal is for you, I think, really, isn't it? Is there any situation that you could talk about where you could potentially move funds from an investment you've got into a different product? I'm talking about GIAs to ISAs. I'll just let you talk a little bit about what a GIA is, a general investment account, for those of you that don't know. But I'll just let you go into a little bit more detail about that and how it's beneficial moving funds between sort of different products. Yeah,
so a general investment account is basically, once you've fully utilised your ISA allowance, it's probably the next best place for you to have that money if you're not looking to get that money tied up towards your pension. Now, the issue with a general investment account, it doesn't benefit from that tax-free wrapper. It is subject to income tax. It is going to be subject to capital gains tax when you do exit. But it's another place to get that money working for you whilst you've utilised all the available allowances, or while you're waiting to make decisions on some things or where to put that money. Because one person might go, well, I've got £100,000 to invest in it. I might put £20,000 in a ISA. I don't really want to put the rest as much in a pension because I might need access to that. The general investment account allows to get that money working in a less tax efficient environment than what an ISA is or a pension, but it gives us the opportunity to have access to it and make a decision to where maybe move that money into the ISA when it gets to the brand new tax year, or to a pension when maybe their circumstances are a little bit clearer and they actually can go, do you know what, I've got a bit more of a longer term investment view and therefore I might actually benefit from the tax relief that a pension contribution could offer.
Okay, so you can actually move money from that GIA into the ISA.
Yeah, into
so
ISA.
You've got your money invested, it's in the markets, it's working for you, and then you're utilising your allowances each year within the ISA.
It's a good way of getting, again, if you're in a lucky position where you can afford to invest in excess of that £20,000 ISA allowance, it's another way to get that money working for you.
Okay.
You've got the right, obviously, like I said before, it is viable to capital gains tax. Our lovely government at the moment give us a CGT allowance, capital gains tax allowance of £3,000 per year. Fingers and toes crossed that's still there after April. Let's hope so. So if there is any gains there, we've got an allowance there. As long as that gain doesn't push you above that £3,000, you don't have to pay any capital gains tax. So it's a nice way of getting that money working in a less tax efficient wrapper, a less tax efficient vehicle. But because the allowances, actually, you can move it into a much better place when you get to the next tax year.
Yeah, even if the transfer takes you above your capital gains allowance, it's still beneficial because then it's growing completely tax free of any capital gains tax and income tax.
And then what you can then do as well, if you've got the capital gains tax which is pushing you over and you're wanting to move that in maybe to a pension, that's when them contributions on the tax relief on the contributions come into play. The rate of tax, you've got 18 and 24%, 18 being basic rate, 24% being higher rate. Instantly, obviously, you contribute to a pension, especially from a personal contribution, you're going to get that 20% at source, which you've mentioned previously, and the additional 20% when you claim it on self-assessment. So yes, although you might be paying tax in excess of that allowance, realistically you're 16% better off. If you work out the numbers, if you're a higher rate taxpayer, because the CG tax is at 24%, you're getting the 20% on the relief for the contribution and the pension, and 20% by a self-assessment. So it is beneficial to move it.
Lovely, thank you very much for that. I think the next thing, obviously, most people today will have some element of workplace pension. Simple question for either of you, really. I'll go to you, Matt, first, I think. Very simple question. Is it worth contributing into your workplace pension?
100%, yeah. It's especially with auto-enrollment these days, you contribute X amount, your employer has to basically contribute the minimum. So they don't have to, they can contribute more than that, which is even brilliant. It's an opportunity for you to invest and get extra money that you didn't have. As lovely as I would like to think I am, I'm not in a position to then, if I talk about a personal pension contribution, people say, don't want to contribute to my workplace, I want to contribute to my personal pension. No, make sure you're doing the minimums with your workplace pension because you're getting your employer's contribution on that as well, which is vitally important. Now, the couple of things you need to think of when you invest in workplace pensions is sometimes their investment strategy might not be the right one for you. It might be targeting a certain age or kick out when you're looking to maybe access these benefits, which might not be suitable or in line with what your attitude to risk is. So there is a drawback to them, but 9 times there's a massive, massive positive to contributing to workplace pensions.
And the other thing I'd add to that as well is some employers will match your pension contributions. So if they do, if you get a pay rise, for instance, try and up your pension contribution a little bit, because then your employer will also up their pension contribution, and it's essentially free money from the employer there by matching that pension contribution. And that's something that I say to like a lot of my friends really is look at the scheme that you're in, ask your employer, do you match contributions? If they do, really take advantage of that, because it's a huge benefit for a lot of people.
Yeah, as you said there, I think it's a phrase I use with a lot of clients, it's free money. Essentially, if you're not making that contribution, it's not money that's coming into your back pocket somewhere else in your paycheck or anything like that. It's a case of it's into your pension, and that's the choice. You either get that or you don't. So I think that's a very important
It's a good
point.
behaviour to have. You never see that money, but actually at some point when you do get to retirement, you're going to benefit from having that behaviour. Something they're not even thinking about, that you're contributing to it, and so is your employer. It's massively beneficial.
Lovely. On to you then, Tom, with just sort of a follow-up to that. You've got a workplace pension. Let's say you're maxing out your contributions and your employer's matching that. Is it then worth contributing more into that, or would you look at potentially a personal pension? Is there a sort of pros and cons to one versus the other? I think Matt touched on a couple of drawbacks there, so
obviously it comes down to looking at the pension itself, and again, this is where you'd speak to a financial advisor about this. We'd look at your current personal pension. Is it better than the workplace pension? If it offers better funds, which are more aligned to your risk, then you could potentially look at your personal pension as well on top of that. But again, we'd have to speak to a financial advisor, look at the two schemes together side by side, work out which one's better, look at charges, look at the options on retirement as well. Do they have flexible drawdown options? Has the workplace scheme potentially got any guaranteed benefits which might be of use as well, such as protected tax-free cash or guaranteed minimum pension or guaranteed annuity rates? So we've got to factor everything into account when we're making that sort of decision. It's not just, 100% go for that personal pension. We've got to make an informed choice in it and have proper advice around that.
Lovely. Thank you for that. Final couple of questions, I think, really. Let's say we've put our plan in place now, we've had all our tax relief, we've built up our pensions over time. We get to retirement. All of a sudden, I'm retired, I'm taking money from my pension to cover my expenditure in retirement. Can I still continue to make pension contributions? I'll go with you, please, Tom.
You can. It really only makes sense up until the age of 75, really, because after 75, you don't get that tax relief. Now, when you're making pension contributions, if you've got at that age, you're going to have no relevant earnings whatsoever. So you are going to be limited to the amount that you can put into your pension at that point. And that amount is 2,880 net, which is before tax relief, and then with tax relief, it's 3,600. So again, speak to an advisor, see if it's worthwhile doing that. We don't want to fall short of any rules as well around pension recycling and stuff like that. We've got to be a bit careful with that. But yeah, you can do, obviously, you speak to an advisor to see if it's worthwhile actually doing that or not. One
last thing just to touch on, the money purchase annual allowance, something that I'm sure a lot of viewers will have heard at some point. I think it's been bandied about on a few programmes recently. Yeah. Would either of you just care to really quickly explain what that is and how it works?
Yeah, money purchase annual allowance is basically how it prevents or locks how much you can contribute into a pension once you've took a taxable income. So it's not triggered by things normally like taking tax-free cash. It's only triggered by taking income flexibly, being the income you're taking being potentially liable to income tax. It might fall below their personal allowance of yours, but you've still triggered that money purchase annual allowance. So the money purchase annual allowance is currently £10,000. Now, this is where it goes different relating to how much you can contribute to your pension and relative pensionable earnings. You have to have pensionable earnings in excess to that amount still. So, for example, if I had no pensionable earnings, which is things like salary and bonus, things like that, I can only contribute the 2,880 net, £3,600 as Tom, because I don't have the earnings to work that. But if you take money, taxable income, trigger it flexibly, what happens is you're basically capped at that £10,000 now in terms of how much you can contribute to the pension.
Lovely, thank you both very much for that. Yeah. So I think today we've talked about the benefits, the tax benefits, certainly of contributing into a pension, contributing into an ISA, and then moving funds between that general investment account and the ISA or pension, as it may be. Again, speaking to an advisor is probably always preferable there, just to make sure you're not doing anything untoward. I think we've discussed a little bit about how that can be drawn, the taxation benefits sort of while it's invested, as well as any taxable or taxation benefits that you're going to get when you start to make those withdrawals. And I think, overall, what we've sort of discovered is that there are sort of many different ways to approach this and make sure that you're going to be getting the most tax efficient income in retirement. I think that's probably the most important thing we've touched on today, is that it's not a one size fits all, everything in a pension, everything in an ISA, and you'll get what you need. I think it's a case of using those different products and sort of making sure that you're in contact with a financial advisor to make sure that you're getting exactly what you need. Thank you both very much for your time today. I think that's been a very useful discussion. Thank you very much for watching.